Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined by Paul Strome, Nicole Dines, and Giles Barry. Nicole, what's your pick of the stories from this week?
I was interested to see that the Westminster City Plan has finally been published. It's been years in the making, and it sets clear rules for up to 2040. And some of the rules are pretty predictable and pretty clear, like, for example, zero carbon by 2040. Any new development will have to commit to that. And the other strong provisions for affordable housing has gone up to 35% of any new development has to be a 35% affordable housing component. So far, so uncontroversial. But what's been more controversial is this proviso that no developments can have flats or houses of more than 200 square meters in size. And the reason, obviously, is they want to maximize the number of houses. Westminster is one of the biggest boroughs in London. It's one of the most densely populated. It's got twice the density of population of the average in London, 12,000 people per square kilometre. So obviously, we can see the reasons for that. But it sort of runs counter. First of all, it runs counter to the post-pandemic trend of people wanting bigger homes, with room for a home office. And it also has a risk of, deterring the big spenders, the big international investors from investing in that borough, because they tend to go for the big trophy homes. It obviously, in the short term, as Savills pointed out in the report on the new plan, in the short term is going to be good news for the developers who got that kind of development, because obviously prices are set to increase because it adds a rarity value. These homes will be even more prized, and the expectation from estate agents that there'll be the bigger homes will actually increase in value per square meter more than the average size home. So that's an interesting development that will change. And obviously, it's been interesting to see what other boroughs do, whether they follow suit or not. And again, on the theme of sort of urban rules and urban regeneration, there was a big development in Milan. We remember we've spoken before about Coima, which has sort of single-handedly changed the face of Milan with the Porta Nuova district. Now they've turned their attention to the Porta Romana, which is a disused railway yard, which has been a real sort of scar next to the center of Milan, because the railway tracks basically divide two areas of the city. So this huge plan. And this week they've announced the winner of the master plan, which is a consortium made up of international architects and experts in all kinds of fields. And it's 100,000 square meters of park. What railway lines there are left will be going underground, and above that will be a kind of New York style high line that will be very green. It will be pedestrianized. So it will really be symbolically, but also very physically linked the two parts of the city that have been separated for many decades. And then also a big residential component, because as Manfredi Matella, the CEO of Coima, told Real Asset Insight, Milan is going to host the Winter Olympics in 2026, and this residential component will be the athletes' village, the Olympic village, but will turn, after the Olympics, will turn into student housing with over 1,000 beds. The real change this time, Catella said, is that the final destination will be very much taken into account as they build the Olympic village, the fact that it's going to be turned into student housing. So it's very much a very more holistic long term of looking at things.
It looks like a really transformational project there in Milan, and it'll be interesting to see how that develops. And of course, in the UK, Giles, we saw the easing of lockdown.
Really big news this week, obviously, Richard, the reopening of non-essential retail, bars and restaurants across the UK. I think it's been a mixed picture. In London, shops, footfall, etc., are trading at about 55% to 60% of 2019 levels, albeit well up on the first day after lockdown last year. So there's still some way to go. I think around the rest of the country, we're looking at 20%, 30% down on 2019 levels. What I think is also really interesting, though, is the rise of retail parks, which maybe 3 years ago was seen as somewhat on their way out. Now, because of the kind of open air, fresh air element and large proportion of click and collect on them, they're doing very well. And British Land produced a trading update earlier this week, which reflected that. Again, just shows the twists and turns that we're seeing all the way through due to coronavirus.
It was interesting also to see the research from Union Investment and JLL on the European grocery real estate market. And I also noticed a growing discussion around schools here in the UK.
I've been in real estate media as a journalist or a communications advisor for over 30 years now, and no one has really talked about schools until Tim Burke in EG published a 4-page feature this week, which I thought was really, really interesting. It was on the rollout of up to 18 schools on big new settlements by Urban and Civic. led by Nigel Bugle and Robin Butler, which was bought by the Wellcome Trust towards the end of last year. Urban and Civic builds new settlements of thousands of homes on brownfield land on the edge of towns that need a lot of housing built according to their allocations. And it goes without saying that secondary schools, primary schools are a big part of that. Now, Urban and Civic builds these, even gets involved with the curriculum. So introducing house builders to the kids at these schools and these settlements, running nature walks, so they understand the kind of surrounding ecology, a whole new world for developers to be involved in. And in the ESG era, a very interesting time to get involved. So, well done, Tim and EG, for writing that.
And that ESG theme actually came up in an interview that I had with Councillor Susan Aitken, who's the leader of Glasgow City Council, looking forward to COP26, which of course is happening in Glasgow in November. Just interesting also to see how I'm beginning to hear more in terms of the market about interest in COP26. And I think that's going to be a much more important focus for the real asset and built environment side than it has done maybe in previous years. So it'll be interesting to see how that moves forward. Paul, what have you been tracking?
We're obviously hearing a lot about ESG at the moment and the way that it's been accelerated, largely I suppose because of changing attitudes prompted by the COVID pandemic. And companies in all sectors are embracing it. But obviously real estate's got a very large part to play. And property owners are under pressure from both their investors and their tenants, as well as the wider community, to do their bit. But clearly, if there's anything worthwhile happening, it'll have a cost. And we're starting to see more lending facilities targeting exactly that. So this week, we heard, for instance, that asset manager Aviva Investors is providing a 72.9 million, that's about 84 million euros, sustainable transition loan to enable developer Commercial Estates Group to improve its portfolio's green credentials. Aviva said that it's committed about £1 billion in sustainable transition debt property over the next 4 years, and it launched its sustainable transition loans framework last December. The loan agreement includes key performance indicators linked to sustainability improvements, so CEG will receive margin reductions for achieving specific targets. In a similar initiative, Singapore-based Temasek and New York's BlackRock have formed a partnership called Decarbonisation Partners, and that's to provide venture capital and private equity aimed at accelerating global efforts to achieve a net zero economy by 2050. The two investors plan an initial $600 million, that's about 502 million euros themselves, which will be invested in funds launched by the partnership. The funds will also raise third-party capital, and there's a target of 1 billion for the first fund. So according to a joint statement, Decarbonisation Partners funds will focus on early stage growth companies targeting next generation renewables and mobility technology, emerging fuel sources, grid solution, battery storage, that sort of thing. So it goes wider than property. Temasek and BlackRock said that they share a belief that climate transition presents a significant investment opportunity. BlackRock's chairman and CEO Larry Fink said that decarbonisation solutions and technologies need to be scaled to transform our economy. And to do that, they need patient, well-managed capital to support their vital goals, he added.
And on that ESG theme, I noticed that CBRE Global Investors Dutch Office Fund was the first in Europe to achieve a World Building Institute award for the whole portfolio. And picking up a theme we've also been following for a while, further evidence in a report from Savills about the growth of UK companies seeking Dutch logistics space post-Brexit, which had already been highlighted in previous interviews with AEW's Dennis Schoenmaker and Jeroen Gerritsen of Panattoni, and suggests that we'll see higher rents and limited supply in the Dutch market. Thank you, Paul. Thank you, Giles and Nicole. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the Week in Real Assets.